Brad Williams, Frugal Finance, stock price movements. In actual market, stock prices change to reflect new information. During a single day, a stock price may change many times. From the relic stock ticker, we can see stock prices when transactions occur. When trading ceases overnight, however, and we know we're moving more towards a 24-hour day trading. When trading ceases overnight, however, we cannot observe the stock price for hours at a time. We can see what's going on with aftermarket activity, but it's not reflective of the market. And I'm not going to dwell on too much of anything that happens post-normal U.S. stock trading. This is just an observation. Our observations are also limited because stock prices are quoted in eighths of a dollar or much less. The true stock price need not jump from one eighth to the next, but the observed stock price does. Sometimes the observed price remains the same from one transaction to another. Seeing the same price twice in a row doesn't guarantee that it stayed constant between those observations. This leads to the understanding that we can never accurately track how stock prices change, since we can't detect the true price at every moment. Any model attempting to describe stock price behavior will always deviate from reality. Nonetheless, let's give it a shot. Despite this limitation, it's possible to create a workable model for understanding stock price movement. In the following section, we'll look into one such model that has found widespread success across various financial applications. Let us consider the random information that affects the price of a stock. We assume that the information arrives continuously. You remember way back when I was saying how important continuous compounding, continuous trading. Here we are, we're stepping into the big leagues. And now we're going to have to use some continuous stuff. And what is that stuff? Well, information arrives continuously, and that each bit of information is small in importance. Remember, we were looking at compounding, and it could be in milliseconds. Well, here we go. Under this scenario, we consider stock price that arises or falls a small portion in response to each bit of information. We know that finance depends conceptually on the twin ideas of expected risk and return. Thus, we might also think of a stock as having a positive expected rate of return. In the absence of special events, we expect the stock price to grow along the path of its expected rate of return. However, the world is risky. Information about a stock can rapidly swing between being good and bad. When this random data comes to light, it sways the stock market from its projected growth trajectory. If the information exceeds expectation, the stock price rises above its anticipated growth rate. Conversely, negative information drags the stock price below its expected trajectory. It's similar to picturing the stock price advancing along its projected growth path like a drunk person traversing a field. Just as we thought the person reaching the other side, despite their meandering and stumbling, we expect the stock price to move higher due to its positive expected return, even though with intermittent fluctuations above and below its growth path influenced by new information. Finance uses a standard mathematical model that is consistent with the story of the preceding paragraph. We assume that stock grows at an expected rate with a standard deviation over time. Let me define what we're trying to do here. S of t is the stock price at the beginning of the interval. Delta S is the stock price change during time. Delta t, S of t, delta t is the expected value of the stock price change during time. Delta t is the normally distributed random variable with the mean u equals 0 and the standard deviation equals 1, and standard deviation of the stock price. 0, 1 is the normally distributed random variable with mean equals 0 and standard deviation equals 1, and this is the standard deviation of the stock price. Equation 13.8 says the stock price change during change in t, which is the change in stock price, depends on two factors: expected growth rate in the price and the variability of the growth. First, the expected growth in the stock price over a given interval depends on the mean growth. Here we have the mean and the amount of time. And up here I said something other than, I should have said S at T, mean, and the change in stock price. Therefore, if the stock price starts at S at T, the expected stock price increase after an interval of stock price T equals this. However, this is only the expected stock price increase after the interval. Due to risk, the actual price change can be greater or lower significantly. Deviations from the expected stock price depends on chance and on the volatility of the stock. The equation captures risk by using the normal distribution. For convenience, the model uses the standard normal distribution, which is a zero mean and a standard deviation of 1. The standard deviation represents the variability of a particular stock. We then multiply the standard deviation of the stock by some random drawing from the normal distribution to capture the riskiness of the stock. Also, equation says that the variability increases with the square root of the interval of stock change right here. Clarification, I was saying this is the change in stock. It's the change in time. Sorry about that. This is the change in stock, S at T. Delta S is the stock price change during time, which is represented by this. Here we have this equation. From this equation, it is possible to show that the percentage change in the stock price is normally distributed. And you can do the math if you want to. Figure 13.3 shows two stock price paths over the course of a year, with both stock prices starting at $100. The straight line graphs a stock that grows at 10% per year with no risk. That could be a fixed income security. This says a stock price at 100 with no risk. Then the jagged line shows a stock price with an expected growth rate of 10% and a standard deviation of 0.2 per year. I'm thinking that standard deviation probably much higher, but we're not going to argue that. We generated the second price path by taking repeated random samples from a normal distribution to create price changes according to 13.8. It's a jagged line in figure 13.8. This might be 13.3. A stock might easily wander. It's a drunken stock. Might wander away from its growth path due to the riskiness represented by its standard deviation or by mem traders. Keep in mind, this looks pretty mathematically. In reality, I'm going to argue that in some cases, you can throw this out the window. That's where momentum comes into play, and we'll get into that later. But construct figure 13.8, we used 1,000 periods per year and a growth rate of 10%. To construct a straight line, we assume that the stock price increased by 0.10 divided by 1,000 each period. However, this gives an ending stock price of 110.51, not the 110 we expected if the stock grows at 10% per year. This difference results from using 1,000 compounding interval during the year. However, we hypothesize that information arrives continuously so that stock price could always change. To stop worrying about the compounding timeline, we now use continuous compounding. Therefore, we focus on logarithmic stock returns. For example, consider a beginning stock price of 100 and an ending price of 110 a year later. The logarithmic stock return over the year is log normal S of T S of O equals 110 divided 100 equals log of 110 equals 0.953. The log stock return is just the continuous growth rate that takes the stock price from its original value to its ending value. Thus, 100 times EXP, mean and time, is equal 100 times EXP 0.093 times 1 equals 110. Have we not seen this sort of pattern before in our compounding and our bootstrapping? We now need a continuous growth model of stock prices that is consistent with our model for the percentage change stock price model of equation 13.9. Using a little math, it's possible to prove the following result. Here we have log normal, S at T, remember up here, S at T, plus time. Divide this by S at T, normally distributed with the mean and looks like a standard deviation of half. Expression asserts that the logarithmic stock returns are distributed normally with the given mean and standard deviation. For the latter time, T plus the change in T, the expected price and variance of the stock price are as follows. Thus, the expected stock price at t plus the change in t depends on the original stock price, S at t, the expected growth rate, m, and the amount of time that elapses, or delta t. Similarly, the variance of the stock price depends on the original stock price, the expected growth, and the elapsed time as well. With a longer time horizon comes a larger variance. The increasing variance reflects our greater uncertainty about stock prices far into the future. As an example, consider a stock with an initial price of 100 and an expected growth rate of 10%. If the stock has a standard deviation of 0.2 per year, we can compute the expected stock price and the variance for 6 months into the future. For this example, we have the following values. S at t equals 1, mean is equal to 10.1, standard deviation of 0.2, and delta time, or change in time, is 0.5. That's what that 0.5 was. That generates this outcome, and it says 100 times E, 0.1 times 0.5 equals 105.13. Variance 100 times 100x 0.05 equals 223.26. Standard deviation of 223. So we're looking at the square of 223.26 equals 1494. Standard deviation of the price over period, delta t, is 1494. That's pretty big. Figure 13.4 not shown shows stock price realizations that are consistent with this example. We found these prices by drawing random values from a normal distribution and using our example growth rate and standard deviation. Each dot in the figure represents a possible stock price realization. Notice that the price tends to drift higher over time, consistent with rising expected value. This is shown by the regression line that is fitted through the points. However, there is considerable uncertainty about what the price will be at any future date. The farther we go into the future, the greater that uncertainty becomes. Well, we know that. If it was that simple, wouldn't we all just be making gazillion dollars? So, research on actual stock price behavior shows that logarithmic stock returns are approximately normally distributed. We can say that as an approximation, stock returns follow a log normal distribution. Stock returns themselves are not normally distributed. As an example, figure 13.5 shows a distribution of stock returns with a mean of 1.2 and a standard deviation of 0.6. It's easy to see that this distribution is not normal given its skewedness to the right. There's a greater chance of larger returns than one would expect with a normal distribution. Figure 13.6 shows the log normal distribution that corresponds to the values in 13.5. The values graph in 13.6 are the logarithms of the values used to construct figure 13.5. The graph in figure 13.6 shows a normal distribution. We will assume that stock returns are distributed as figured in 13.6, except that the mean and standard deviations differ from stock to stock. So while the log normal distribution only approximates stock returns, it has two great virtues. One is mathematically workable, so we can get answers for the value of call options if stock returns are distributed log normally. Second, resulting call option price that we compute are very good approximation of actual market prices. In interest rate options, we treat stock returns as log normally distributed with a specified mean and variance. I suspect you fell asleep about paragraph 3, woke up at paragraph 5, fell asleep again at paragraph 7, and now are walking like that drunk sailor going, "What the hell are you talking about, Williams?" This is some serious math. That's all I'm going to say. Finance can be simple or it can be complex. It's up to you as to what route you want to take. Me, I like statistics. I like some variation. I like computing this stuff. But when it comes to rubber meeting the road, is this academic or is this reality? This wraps up the stock future courses. We're going to get into interest rate options next. Sorry to say, that is Black-Scholes. And if this is overbearing, then my suggestion is just reread this. Just play around with the numbers. When we have to try to digest this stuff, it's just, one, it's boring as hell. Two, it's just part of the process. Make sure you have a strong cup of coffee. I like to do this stuff early in the morning because you just need some clarity. And when you start working with this stuff, it's not something you deal with day in and day out until you actually start doing it on a day-to-day basis. That being said, this is a wrap. Got a lot more to cover. Now, it's up to you if you want to step into the next course. Stock index futures are fun, but it's complex. Brad Williams, Frugal Finance, Williams out.